Welcome to the new episode. Myself Jessa and I am your host for this explanatory video. If you are new to our channel, please like, share and subscribe to our channel. We once again welcome you to our video. So let's begin. Today we are going to talk about understanding the basics of investing in mutual funds. A mutual fund is a trust that collects money from investors who share a common financial goal, and invest the proceeds in different asset classes. By pooling money together in a mutual fund, investors can enjoy economies of scale and can purchase stocks or bonds at a much lower trading cost compared to direct investing in capital markets. The other advantages are diversification, stock and bond selection by experts, low costs, convenience and flexibility. An investor in a mutual fund scheme receives units which are in accordance with the quantum of money invested by him. These units represent an investor's proportionate ownership into the assets of a scheme, and his liability in case of loss to the fund is limited to the extent of amount invested by him. The pooling of resources is the biggest strength for mutual funds. The relatively lower amounts required for investing into a mutual fund scheme enables small retail investors to enjoy the benefits of professional money management and lends access to different markets, which they otherwise may not be able to access. The investment experts who invest the pooled money on behalf of investors of the scheme are known as fund managers. These fund managers take the investment decisions pertaining to the selection of securities and the proportion of investments to be made into them. Today, there are a variety of schemes offered by mutual funds in India, which cater to different categories of investors to suit different financial objectives. Some schemes may provide capital protection for the risk-averse investor, whereas some other schemes may provide for capital appreciation by investing in mid or small cap segment of the equity market for the more aggressive investor. The diversity in investment objectives and mandates has helped to classify and subclassify the schemes accordingly. The broad classification can be done at the asset class levels. Thus we have equity funds, bond funds, liquid funds, balanced funds, gilt funds, etc. These can be further subclassified into different categories like mid-cap funds, small-cap funds, sector funds, index funds, etc. Types of mutual funds. Open-ended funds. An open-ended fund or scheme is one that is available for subscriptions and redemptions on a continuous basis. Investors can conveniently buy and sell units at net asset value, NAV, related prices which are declared on a daily basis. Close-ended funds. A close-ended fund or scheme has a stipulated maturity period which can range from a few months to a few years, for example 6 months, 5 years or 7 years. Fund is open for subscription only during a specified period at the time of launch of the scheme, which is the new fund offer, NFO. Investors can invest in the scheme at the time of the NFO and thereafter. Interval funds. These schemes are a cross between an open-ended and a close-ended structure. These schemes are open for both purchase and redemption during pre-specified intervals, viz. monthly, quarterly, annually, etc., at the prevailing NAV-based prices. Interval funds are very similar to close-ended funds, but differ on the following points. They are not required to be listed on the stock exchanges, as they have an inbuilt redemption window. They can make fresh issue of units during the specified interval period, at the prevailing NAV-based prices. Maturity period is not defined. Exchange-traded funds. Exchange-traded funds or ETFs are essentially index funds that are listed and traded on exchanges like stocks. They enable investors to gain broad exposure to indices on stock markets in India and in some cases in other countries as well. These indices, if based on certain specific sectors/themes with us, provide exposure to such sectors with relative ease, on a real-time basis and at a lower cost than many other forms of investing. For example, there are ETFs that track S&P CNX Nifty, BSE Sensex, etc. Gold ETF are mutual fund schemes where the underlying investment is in physical gold. Fund of funds. Fund of funds, FOF, as the name suggests, are schemes which invest in other mutual fund schemes. The concept is popular in markets where there are a number of mutual fund offerings, and choosing a suitable scheme according to one's objective is tough. Just as a mutual fund scheme Invests in a portfolio of securities such as equity, debt, etc. The underlying investments for a FOF is the units of other mutual fund schemes, either from the same fund family or from other fund houses or from funds domiciled outside the home country, known as overseas feeder fund or fund of funds, explained in detail under section Types of Equity Funds. Classification based on investment objective. Apart from the above classification, mutual fund schemes can also be classified based on their investment objectives. Equity funds, growth/equity-oriented schemes are those schemes which predominantly invest in equity and equity-related instruments. The objective of such schemes is to provide capital appreciation over the medium to long term. These types of schemes are generally meant for investors with a long-term investment horizon and with a higher risk appetite. Types of equity funds. Multi-cap funds. These funds invest across the market capitalization in large, mid and small cap companies. Large cap. These funds invest predominantly in large companies. Generally, large cap companies experience a slower growth rate and have much lower risk than mid-cap companies due to their size. They are also known as blue-chip companies. Mid-cap. These funds invest predominantly in mid-cap companies. Most mid-cap companies experience higher growth than a large-cap company. Small cap. Small cap refers to a company that it is relatively new and has lower market capitalization. Of the three, small cap companies represent the most investment risk but also the highest return potential. Tax saving fund. These funds are also known as equity-linked savings schemes, ELSS. In case of ELSS schemes, investment up to 1 lakh rupees qualify for deductions under Section 80C of the Income Tax Act, 1961. However, these schemes have a lock-in period of 3 years. Equity international. These funds invest in companies of foreign country. The investment could be specific to a country, like the China, US fund, etc., or diversified across country/region, like Europe, Asia, etc. By seeking exposure to foreign stocks in portfolio, one can spread investment risk and achieve diversification. AMCs generally tie up with a foreign fund. And in India they launch a feeder fund. The money collected in the feeder fund is invested in the underlying fund. Sometimes AMCs also launch schemes investing directly in equity securities of international companies. In such schemes, the local investors invest in rupees for buying the units. The rupees are converted into foreign currency for investing abroad. Thus, there is an element of foreign currency risk while investing in such schemes. Also, it should be noted that tax treatment of international equity funds is similar to debt funds. Equity income, dividend yield schemes. Dividend yield schemes generally invest in a well-diversified portfolio of companies with relatively high dividend yield, which provides a steady stream of cash flows by way of dividend. Arbitrage funds. These funds exploit arbitrage opportunities such that the risk is neutralized, but a return is earned. The arbitrage is sought by taking advantage of a price differential of the same asset between two or more markets, say, taking advantage of the mispricing between the cash and derivatives market. These funds generally have low risk-return trade-off. Index funds. Index funds invests in companies that constitute the index and in the same proportion, in order to replicate a specific market index and provide a rate of return over time that will approximate or match that of the market which they are mirroring, subject to tracking error. Income/debt-oriented funds. Such schemes generally invest in debt securities like treasury bills, government securities, bonds and debentures, etc. They are considered less risky than equity schemes, but also offer lower returns. Gilt funds. These funds invest exclusively in government securities. Government securities have no default risk. NAVs of these schemes also fluctuate due to changes in interest rates and other economic factors, as is the case with income or debt-oriented schemes. Money market/liquid funds. These funds aim to provide easy liquidity, preservation of capital and moderate income. They invest in safer short-term instruments such as certificates of deposit, commercial paper, etc. These schemes are used mainly by institutions and individuals to park their surplus funds for short periods of time. These funds are more or less insulated from changes in the interest rate in the economy and capture the current yields prevailing in the market. Hybrid funds. Balanced funds. These are the funds that aim at allocating the total assets with it in the portfolio mix of debt and equity instruments. Balanced funds provide investor with an Option of single mutual fund that combines both growth and income objectives, by investing in both stocks, for growth, and bonds, for income. Balanced funds are also called equity-oriented funds, and their tax treatment is similar to an equity fund. Their average returns and risk profile fall somewhere in between growth and debt funds. Monthly income plans. These plans seek to provide regular income by declaring dividends. It therefore invests largely in debt securities. However, a small percentage is invested in equity shares to improve the scheme's yield. Monthly income plan are also called debt-oriented hybrid schemes. Monthly income is, however, not assured and depends on the distributable surplus of the scheme. Capital protection-oriented schemes. These are mutual fund schemes which endeavor to protect the capital invested therein through suitable orientation of its portfolio structure. The orientation towards protection of capital originates from the portfolio structure of the scheme and not from any bank guarantee, insurance cover, etc. SEBI stipulations require these type of schemes to be close-ended in nature. Investment options for investors. Investment plans. Direct plan. Under direct plan, investors can invest directly with a fund house wherein no agent or distributor is involved, and thus they can save on costs. The direct plan has a separate NAV, which is generally higher than normal or regular plan, as direct plan charges lower expenses because it does not entail paying any commission to agent, distributor, and thus gets reflected in the form of higher NAV. Regular or normal plan. Under regular or normal plan, investors can invest through an agent or distributor in order to avail their investment advice/services. The regular plan too has a separate NAV, which is generally lower than direct plan, as former charges higher expenses in order to pay commission to an intermediary. Investment options. Growth option. Under growth option, dividends are not paid out to the unit holders. Income attributable to the unit holders continues to remain invested in the scheme and is reflected in the NAV of units under this option. Investors can realize capital appreciation, if any, by way of an increase in NAV of their units by redeeming them. Dividend payout option. Dividends are paid out to the unit holders under this option. However, the NAV of the units falls to the extent of the dividend paid out and applicable statutory levies. Dividend reinvestment option. The dividend that accrues on units under option is reinvested back into the scheme at ex-dividend NAV. Hence, investors receive additional units on their investments. Benefits of mutual funds. Professional management. Mutual funds provide the benefit of professional management, as people's money is managed by experienced fund managers. Investors, who do not have time, inclination, and the know-how to manage their investments, can look towards mutual funds as an alternative. It is inexpensive and is ideal for a small-ticket investor. Economies of scale. The way mutual funds are structured gives it a natural advantage. The pool of money from a number of investors ensures that mutual funds enjoy economies of scale. It is cheaper compared to investing directly in the capital markets, which involves higher charges. This also allows retail investors access to high entry-level markets like real estate. Diversification. Mutual funds provide investors with the benefit of diversification across different companies and sectors. Diversification in simple terms means to spread your portfolio across different instruments, sectors, industries, companies, and countries, so that the overall portfolio is relatively safeguarded from downturns in one or more sectors, companies, or countries. Since small investors do not have enough money to make meaningful investments across different assets, a mutual fund does the job for them. Liquidity. Open-ended mutual funds provide easy liquidity, and investors can buy or sell units anytime, at the prevailing NAV-based prices. Close-ended schemes are listed on a stock exchange where investors can redeem their units at the prevailing market price. Interval funds, which are a cross between a close-ended and an open-ended structure, also provide periodic liquidity option to its investors. Flexibility. There are a lot of features in a regular mutual fund scheme, which imparts flexibility to the scheme. An investor can opt for a systematic investment plan, SIP, systematic withdrawal plan, SWP, systematic transfer plan, STP, etc. Convenience. Mutual fund companies offer convenient routes to investing in their schemes. Investors can invest through the internet or mobile phone, in addition to the conventional option of physically filling up an application form and submitting it. Further, as bank details are required to be submitted at the time of investment, redemptions become very convenient, as an investor directly receives the proceeds in the bank account. Transparency. The mutual fund industry in India works on a very transparent basis. and various kind of information is available to their investors through fact sheets, offer documents, annual reports, etc. Well regulated. Indian mutual fund industry is well regulated by the Securities and Exchange Board of India, SEBI. This helps to instill confidence and provides comfort to the investors. The regulatory environment in India is quite healthy, and ensures transparency in the processes and transactions. The best practices adopted by the industry in India have helped them win investors' confidence over the years. The ease and convenience which mutual funds offer in the different variety of schemes made available. The ease and convenience which mutual funds offer in the different variety of schemes made available to the investors creates popularity for mutual funds, which cuts across investor classes and creates a favorable appeal. Myths of mutual funds. Lower NAV is cheaper. The most common myth that is prevalent among mutual fund investors is that of associating a scheme with a lower NAV being a better buy compared to a scheme with a higher NAV. This stems from the mindset of equating mutual fund units with equity shares of a company. NAV of a scheme is irrelevant, and irrespective of whether we are investing into a fund having a low NAV or a fund with a higher NAV, the amount of investment remains the same. Regular dividends means good performance. Another popular myth which emerges due to the linkages we make between the concepts of the stock markets and mutual funds is the dividend payout mechanism. When a company pays dividend, in effect it is transferring a certain portion of its surplus to its shareholders. Therefore, a generous dividend payout policy could be considered favorable in case of a company. However, in case of mutual funds, dividends are declared out of the distributable surplus, which is included in calculation of net asset value. In effect, it is paying back a certain portion of net assets from our own investments. Therefore, dividends from mutual fund units don't make us any richer, as there are no additional gains to be made. The NAV of the scheme falls to the extent of the dividend payout, when a scheme pays dividend. Thus, a scheme with a high dividend payout record does not necessarily mean that it is performing well. Dividend option may prove important to plan cash flows, especially in the case of tax savings. Myths of mutual funds. Loads or sales charges. Loads are charges which investors incur when they redeem units in a mutual fund scheme. A load charged at the time of redemption is known as exit load or back-end load. Asset management companies charge these loads to defray the selling and distribution expenses, including commission paid to the agents/distributors. Since August 1, 2009, entry load has been banned, and therefore purchase/subscription of mutual funds happen at a price which is equal to the NAV. However, an investor is required to pay an exit load, if any, if he chooses to redeem units. This happens at a price linked to the NAV. This repurchase price may differ from NAV to the extent of exit load charged, if any. Recurring expenses. These are costs incurred for day-to-day operation of a scheme. These expenses inter alia include investment management and advisory fees, trustee fees, registrar's fees, custodian's fees, audit fees, marketing and selling expenses including agent's commission, etc. Expenses exceeding the specified limit are borne by the AMC. Demat account is required for mutual fund investments, except in case of schemes which are listed on the stock exchange and are available on their platforms. Demat account is not required to own units in a mutual fund scheme. Past performers are the best funds to buy. Despite the disclaimers, mutual fund investors tend to invest in the top performing scheme of the last year, hoping that past performance will ensure that the scheme continues to stay at the top. Therefore, instead of chasing the top performer in the short term, it is advisable to invest in a scheme which features in the top quartile consistently over a longer period of time. In addition to past performance, the investors should also consider other factors, viz. professional management, service standards, etc. Fees and expenses. As is the case with any other business, running a mutual fund business also involves costs. The various costs incurred by a mutual fund could be associated with transactions made by investors, operating costs, marketing and distribution expenses, etc. Disclaimer. This video is made for the purpose of educating and knowledge sharing only. Mutual funds investments are subject to market risk. Kindly read the offer documents carefully before investing. Thank you for your valuable time. Please like, share and subscribe to our channel.